Retail sales surging in March, seeing the largest and the biggest monthly jump in 2 years, boosted by a surge in car purchases ahead of President Trump's planned tariffs on the industry. The pre-tariff activity showing consumers rushing to buy goods ahead of the high trade levies. Joining us now for more, we've got Moody's Analytics Chief Economist Mark Zandi. Mark, good to see you here this morning. Just want to take us into your first reaction here, most notably on the retail sales picture. What are you seeing there?
Yeah, I think you got it right, Brad. I think there was a lot of forward buying, particularly for vehicles. I think consumers are well aware of the tariffs and the impact that that's going to have dead ahead, and decided to get that car before its price increased. So I think, if my memory serves, we sold 17.5 million vehicles, light vehicles, in the month of March. That's annualized, obviously, and that's up 1.5 million compared to where it was prior to that, kind of the underlying trend. So, I think retailing is okay through March. Yeah, the forward buying certainly helped, but obviously that steals away from future consumer spending and retail sales, which augurs poorly for the future.
How poorly for the future, Mark? I wonder, I know that you had a recession call of around 60% odds of a recession as of April 10th. Where does that call stand for you today?
About the same. I think odds are better than even. Madison, that will suffer a recession starting at some point this year. To be precise, 60%. So that hasn't changed. I think there's still a 40% chance we don't go into recession, and it depends on what the Trump administration does with the tariffs. If they take an off-ramp here and continue to de-escalate, lower the tariffs that they've imposed or threatened to impose, and figure out a way to, cool things off, then we've got a chance to navigate through without a downturn. But that doesn't feel like what's going to happen, at least not right now. If the trade war continues to intensify, I think a recession is more likely than not.
Okay, and so as we're thinking about this, Treasury Secretary Scott Bessent spoke with Yahoo Finance about one of the volatile points that we're seeing right now in the bond market. And I want to get your reaction to this, as he's saying that it's possibly being driven by foreign interference, specifically by China. Here's what the Secretary had to say.
I think if Treasuries hit a certain level, or if the Federal Reserve believed that a foreign, I won't call them an adversary, but a foreign rival, were weaponizing the U.S. government bond market or attempting to destabilize it for political gain, I am sure that we would do something in conjunction with each other. But we just haven't seen that.
And so with that in mind, and of course, they're using kind of the bond market and the levels for 10 years specifically as their guide towards how that influences housing, which I also know that you watch very closely. So just want to get your reaction to how the White House is evaluating the bond market right now.
Yeah, I'm not aware of any interference like that you're alluding to, and I'm not even sure the Secretary was alluding to that either. It sounded like more like a what if. I haven't seen that. I mean, what I have seen is that global investors are more cautious with regard to investing in U.S. Treasury bonds. And that's a big change. In times past, when there's a crisis, and I would consider the current period a crisis, money comes flowing into the United States. Global investors want the safety, the safe haven of the U.S. Treasury. We're AAA, we're money good. And I think that confidence that is so key to that has been shaken by the global trade war. And I think that's being reflected in bond yields. It's not like bond yields have risen a lot. I just looked, we're at 435, I think, on the 10-year Treasury. But they're going up as opposed to down. And you would have thought yields would be much lower now, given if there was a flight to safety, and that's not happened. So I think that's something to be very worried about, nervous about for the long run, because even a few basis points, if interest rates are just even a few basis points higher than they would have been otherwise, that's a lot of interest payments we're going to pay on the debt because the debt is as large as it is. So this is a really big deal.
It certainly is, and it makes me wonder about the other monetary policy elephant in the room, which is the Federal Reserve. Mark, talk to me about how you're thinking about how the Fed might respond to this, especially as we gear up to hear from Fed Chair Jay Powell later this afternoon.
Yeah, they're going to sit on their hands. I don't think they know what to do with all of this. A lot of economic policy going on, a lot of uncertainty around all of it. But the tariffs are particularly difficult for them to navigate. They will raise inflation, and inflation expectations are way up. I'm sure they're very nervous about what that means, and that would imply no rate cuts or even potentially higher rates. And then, of course, the tariffs are a tax, a very significant tax on consumers and businesses, which weakens growth, and that by itself would argue for lower interest rates. So, what do you do? Respond to the inflation or to the weaker growth? And I don't think they have any clarity on that until they do. I think they sit on their hands. So I expect the federal funds rate to stay exactly where it is until one or the other, inflation or growth, begin to dominate.
Sounds like you think the Fed is going to stay where they are, but you're also saying a recession is more likely than not. Two very important takeaways for our viewers, Mark. Thank you so much for joining us this morning. Appreciate it.
Yeah, anytime. Thank you.